Starting with GPUS, which is also known as Hyperscale Data Inc. This company has been making some serious waves in the market lately. They recently reported preliminary Q1 revenue of over $25 million, which is a substantial figure for a company of their size. And they've set an ambitious full-year revenue target for 2025 in the range of $115 to $125 million. That's a big leap, and it shows they're not just resting on their laurels. What's more, they recorded a one-time gain of $9.7 million, and they're in the process of converting one of their facilities into an AI data center. This kind of pivot is exactly what the market loves to see right now, given the AI craze and the insatiable demand for data infrastructure. The market has responded in kind. The stock has shot up over 400% in a relatively short time, which is both exciting and a little nerve-wracking. When you see that kind of movement, it's a double-edged sword. On one hand, it shows there's real momentum, but on the other, it means volatility is through the roof. Analyst sentiment is bullish, with a consensus outperform rating and an average score of 2.0 on a scale where 1 is a strong buy. Price targets from analysts are extremely optimistic, with some projecting even more upside, but more conservative models like GF value suggest a more moderate, but still respectable, 38% upside from current levels for someone with a higher risk tolerance and an appetite for growth. GPUS looks like a speculative buy. It's not for the faint of heart, but if you can stomach the swings, you could be rewarded handsomely. Just be prepared for a bumpy ride and consider scaling in rather than going all in at once. Moving on to NCNA, or Nucana, things look a bit less rosy. The analyst sentiment here is mixed at best, with 1 buy and 3 hold ratings, and no strong buy recommendations. The company's earnings outlook is negative, with a projected EPS of 5 cents for 2025, which means they're still burning cash and haven't turned the corner to profitability. There's no real catalyst on the horizon, and the stock doesn't have the kind of momentum or narrative that excites investors right now. Fundamentally, it's just not compelling. NITO, which is also listed as N2OFF, Inc., presents an interesting case. Technically, the stock is showing some positive signs. Both short and long-term moving averages are flashing buy signals, and there's been a recent pivot bottom, which could indicate a reversal. Volume is picking up, which suggests that more traders are starting to pay attention. However, when you dig into the fundamentals, the picture isn't as pretty. The company is still posting negative income, and its price-to-sales ratio is high, which means the market is already pricing in a lot of future growth that may or may not materialize. iPower ratings put it at a hold with a score of 4 out of 10, indicating a below-average probability of beating the market in the next 3 months.